Warren Buffett is widely recognized today as the greatest investor of all time, having delivered an impressive 20% annual return through his company, Berkshire Hathaway, since 1965. No one else even comes close to matching that track record. And the more you dig into his life and methods, the more apparent it becomes that his achievement is almost impossible to duplicate. But how exactly did the Oracle of Omaha pull it off? What were the choices he made, the tactics he followed, and the investments he secured that transformed just $1,000 into over $160 billion? Buffett's journey to immense wealth began unusually early. Born in 1930 in Omaha, Nebraska, young Warren was endlessly curious about making money. One of his earliest influences came from a book he found at age 7 titled 1,000 Ways to Make $1,000. Before long, Warren was going door to door selling chewing gum and Coca-Cola, earning a few cents with each sale. But it was at the age of 11 that he truly dipped his toes into the world of stocks. Yes, just 11 years old. He had managed to save $114.75, which he used to purchase 3 shares of City Service preferred stock at $38 apiece. Almost instantly, he experienced the unpredictable nature of the stock market. The price dropped to around $27, testing his young resolve. Fortunately, Warren held on until it rose to $40 and sold, earning a modest return, but more importantly, a profound lesson. Shortly after he sold, City Service stock soared past $200 per share, showing Buffett just how costly acting too soon could be. Still, he wasn't discouraged. In his own words, "I'd become a capitalist, and it felt good." Buffett's entrepreneurial instincts flourished throughout high school. He bought a used pinball machine with a friend for $25 and placed it inside a barbershop. As they began collecting quarters, they expanded to 3 machines across different spots. By the time Warren was 16, he and his friends sold the business for $1,200. Between that and his other ventures, he finally reached his $1,000 goal. In fact, by 15, after running several paper routes in Washington, D.C., where his family had relocated, Buffett had managed to save around $2,000, worth over $35,000 in today's money. At 14, he used $1,200 of his earnings to purchase 40 acres of farmland in Nebraska, teaming up with a local farmer to operate it. Always thinking ahead, Buffett had saved up $9,800, or roughly $180,000 in today's terms, by the time he completed college. His first $1,000 and even his initial $10,000 came from sheer effort, a sharp business sense, and a relentless work ethic. But by his early 20s, he realized he needed a more efficient strategy to scale his wealth. In 1950, he read Benjamin Graham's groundbreaking book The Intelligent Investor, which had a life-altering effect on him. He enrolled at Columbia Business School specifically to study under Graham. Graham's style was value investing, though quite different from the version we know now. Buffett described it as cigar but investing, buying shares in struggling companies that might be nearly worthless, but cheap enough to offer one last profitable puff. After completing his master's degree, Buffett joined Graham's firm, Graham Newman Corp., gaining practical experience in deep value investing. Armed with knowledge, Buffett returned to Omaha in 1956 and, at just 25 years old, launched his own investment partnership. He gathered about $105,000 from close friends and family, including his sister, aunt, and father-in-law, but only contributed $100 himself. Even that small stake proved unnecessary, as the fee structure was very favorable: no management fees, no fees on the first 6% in annual gains, and 25% of profits beyond that threshold. This setup provided plenty of compensation for Buffett and launched his path from modest beginnings to millions. With the capital from his partners, Buffett went bargain hunting in the stock market. His approach back then mirrored Graham's cigar butt philosophy, and it worked wonders. His partnership consistently delivered a compound annual return of 25.9%, catching attention across the investment landscape. So what types of stocks was he buying? Generally, tiny, overlooked companies whose shares traded at extreme discounts relative to their assets or earnings. One of Buffett's early standout investments was in Sanborn Map Company. Though Sanborn's main business, providing maps to insurance firms, was in decline, it possessed a valuable portfolio of investments. Buffett noticed that Sanborn's shares were trading at about $45 each, while the underlying value of its investment holdings alone was $65 per share. In other words, the market was treating Sanborn like a fading map producer and ignoring its significant financial reserves. Seeing a textbook value opportunity, Buffett's partnership acquired as many shares as possible, eventually owning 43% of the company. He then joined the board and persuaded management to buy back stock at $65 per share, unlocking shareholder value. The result: a 44% return and a successful final puff from that cigar butt. Buffett's most significant triumph of the 1960s hinted at a broader shift in his strategy. In 1964, American Express faced a scandal when a subsidiary was caught using tanks of water as collateral, masquerading them as soybean oil. Investors panicked, and the stock plummeted. But Buffett noticed that Americans were still using their green Amex cards in restaurants and stores. The brand's integrity remained strong. So while others sold, Buffett bought in, ultimately placing 40% of his partnership's funds into Amex. It was bold, and it paid off. This wasn't a cigar butt, it was a quality business going through a temporary crisis. Buffett's strategy was evolving. By 1962, the partnership had grown significantly. Buffett's share alone made him a millionaire, with total partnership assets surpassing $7 million. At just 32, he had turned $100 and some early backing into a personal fortune. At this point, Buffett began seeking larger, more impactful investments. One such opportunity came in 1962 when he found Berkshire Hathaway, a struggling textile firm, trading well below its asset value. Staying true to his value roots, he bought in. But when CEO Seabury Stanton failed to honor a buyback agreement, Buffett retaliated by acquiring enough stock to take control and firing Stanton. It was one of the few times emotions got the best of him. Now, he was in charge of a dying textile firm. By the late 1960s, Buffett faced a unique problem: too much capital and too few attractive opportunities. With markets soaring and bargains drying up, he made a bold move in 1969. He shut down his partnership and returned the capital to investors. He jokes that by 1970, he had quit his successful career to become the full-time chairman of Berkshire Hathaway, a position he still holds. This marked a major turning point. Buffett was transforming from a small stock specialist into the leader of a massive holding company. By 1970, Buffett was already very wealthy. But to take things further, he needed a new method. And this is when Charlie Munger stepped into the spotlight. Munger, a brilliant thinker and Buffett's longtime friend, began influencing his strategy more deeply in the 1970s. His core advice: stop chasing cigar butts and start buying exceptional businesses. Charlie argued that some companies were worth paying a premium for because of their long-term potential. In essence, it's better to buy a fantastic company at a decent price than a decent company at a bargain price. This mindset shift became the most pivotal moment in Buffett's investing career. Buffett now had Berkshire Hathaway as his new vehicle. After acquiring National Indemnity in 1967, the big test of this new approach came in 1972, when he considered buying See's Candies. See's was a well-loved West Coast chocolate company with loyal fans and pricing power. But it looked expensive by old Buffett standards. The asking price was $30 million, for a business with only $8 million in tangible assets and $2 million in profit. Buffett hesitated. But Munger and another partner pushed hard, emphasizing the strength of See's brand moat. Buffett negotiated. He wouldn't go above $25 million. Thankfully, the seller agreed. That deal ended up making billions for Berkshire Hathaway. Buffett would later say, "I almost blew the See's purchase. If the seller hadn't given in, I'd have missed out, and that $2 billion profit would have gone to someone else." See's taught Buffett and Munger that a stellar business is worth far more than its assets. It reinforced their pivot toward companies with enduring competitive edges, or moats. Buffett still cared about price. But after See's, he was comfortable paying more for quality. That opened the door to famous investments in the 70s and 80s. For example, in 1973, Buffett bought a large stake in the Washington Post during a market slump. Though temporarily undervalued, its core franchise was strong. His $10 million stake later grew to over $1 billion by the 1990s. Another was Geico. In 1976, when Geico was near bankruptcy, Buffett invested heavily. He believed in their direct-to-consumer model and cost advantages. Geico not only recovered, but flourished, becoming a major Berkshire asset. These were classic Buffett moves, buying when others were fearful, but now with a focus on long-term winners. Berkshire became a compounding machine in the 1980s. One of the biggest snowballs began rolling in 1988 with Coca-Cola. After the 1987 crash, Coke's stock had fallen, though the company itself was still strong. Buffett saw its brand, its reach, and its addictive product, and invested over $1 billion to buy 6.2% of the company. That was massive. Coke became Berkshire's top holding, and it paid off. By 1989, Berkshire's Coke stake was worth $1.8 billion. Today, it's valued over $25 billion. The annual dividends alone are around $700 million, more than half of what he originally spent. It's the perfect example of long-term compounding, and it confirmed Buffett's refined approach: buy an exceptional business at a fair price and let time do the work. By 1986, Buffett was a billionaire on paper. His evolution, from bargain hunter to conglomerate CEO, was complete. With Munger's guidance, he shifted from merely finding cheap companies to owning phenomenal ones. But the journey didn't stop at $1 billion. In fact, that was just the beginning. From the 1990s onward, Warren Buffett faced a new kind of challenge: managing ever larger amounts of money while remaining loyal to his value-based principles. Berkshire Hathaway had grown so enormous that Buffett jokingly said he needed to find elephants to invest in. Small deals just didn't make much of a difference anymore. So, he began targeting larger opportunities, sometimes acquiring entire companies outright. This era of Buffett's career was all about scaling and solidifying his reputation as the most successful investor in the world. One of the defining traits of Buffett's post-1990 strategy was his patience and discipline during turbulent markets. For instance, during the dot-com bubble of the late 1990s, as tech stocks soared to extreme valuations, Buffett mostly sat on the sidelines. He didn't pour money into flashy internet startups he didn't fully understand. Critics accused him of falling behind the times. But when the bubble eventually burst, Berkshire emerged largely unscathed, reinforcing Buffett's image as a voice of reason in a volatile market. Instead of tech companies, he focused on established businesses with strong earnings and defensible moats. Around this period, Buffett was making investments in Coca-Cola, Gillette, American Express, and Wells Fargo, companies with brand strength and reliable profitability. By the mid-2000s, Buffett's cash reserves had ballooned into the tens of billions. He waited patiently for the right opportunities. Then came the 2008 financial crisis. During the turmoil, Buffett acted like a lender of last resort for major corporations. He struck highly favorable deals with companies like Goldman Sachs and General Electric, injecting capital in exchange for preferred shares and high-interest returns, plus equity warrants. These transactions were incredibly profitable and cemented his role as a stabilizing force during crises, a financial white knight. However, one of the biggest contributors to Buffett's wealth in recent years came from an unexpected area: the technology sector, which he had long been wary of. Enter Apple. Yes, the same investor who had avoided tech for decades ended up making one of the most lucrative tech investments of all time, and it paid off massively. How did this come about? Around 2016, Buffett's investment lieutenants, Todd Combs and Ted Weschler, began buying Apple stock, with Buffett's full approval. The move surprised many. Apple didn't seem like a typical Buffett company. But he eventually came to see Apple not just as a tech firm but as a dominant consumer brand with a fiercely loyal customer base. The Apple ecosystem, iPhones, iPads, Macs, App Store, and services like iCloud, created recurring revenue and sticky users. Plus, the company had a mountain of cash on hand. Apple fit Buffett's key investment criteria: strong brand, pricing power, customer loyalty, and effective leadership. So, Berkshire kept buying. By 2018, it had amassed a 5% stake in Apple after investing around $30 billion. The value of that position soon soared. As Apple's stock surged through the late 2010s and into the 2020s, Berkshire's stake became increasingly valuable. By the end of Q4 2023, Apple made up nearly half of Berkshire's $350 billion stock portfolio. At one point, Berkshire's Apple shares were worth $160 billion. The profit from this investment alone added tens of billions of dollars to both Berkshire Hathaway's value and Buffett's personal net worth. It turned out to be the ultimate proof that Buffett's investing philosophy, looking for strong brands with durable advantages and quality leadership, could work even in the tech world as long as the business fundamentals were right. In early 2021, thanks to the skyrocketing value of Apple and other key holdings, Warren Buffett officially joined the elite club of individuals with over $100 billion in net worth. As Berkshire's stock hit record highs, his wealth passed that milestone and kept climbing. Today, Buffett's estimated fortune stands at around $165 billion. What's truly remarkable is how he built it. Buffett never launched a massive tech company. He never took an enormous salary. He didn't inherit a vast estate. His fortune is almost entirely the result of smart, disciplined investing and patience. The snowball started rolling nearly 80 years ago, and it hasn't stopped. So, what lessons can we draw from Buffett's story? He became wealthy by sticking with one timeless strategy: buy great businesses at reasonable prices and hold them for the long term. But it wasn't just about picking good stocks. Buffett demonstrated unwavering discipline, avoiding hype cycles and letting cash sit idle when no good opportunities were available. His commitment to frugality and reinvesting profits helped Berkshire grow exponentially over time, turning every retained dollar into something far greater. Now valued at more than $150 billion, Warren Buffett's story shows that methodical, principled investing, combined with the patience to let time do the heavy lifting, can generate unimaginable wealth. And before we wrap up, if you enjoyed this video and you're curious about learning the full ins and outs of Buffett's approach, don't forget to subscribe to Invest Focus and check out the recommended books in this video description. That's it for now. Thanks so much for watching. Don't forget to like the video if you found it helpful, and I'll catch you in the next one.